Thank you very much, everyone, for joining us today. First, I'd like to thank Nicholas and the team for putting together this fabulous day. It's been a wonderful forum so far, and hopefully the rest of the day will be just as good. My name is Tony Renzi. I'm a shareholder at Vedder Price, and this is the Ship Finance and latest trends and developments panel. We have a fantastic panel here today. I'll introduce the panelists, and then we'll kind of just jump into it. So, to my left is Ted Young. Ted is the Chief Financial Officer of Dorian LPG. Next is Andrew Shohet, who's a Senior Vice President at D&B and Head of Ocean Industries for North America. And next to him is Evan Cohen, who's a Managing Director and Group Head of Finance at First Citizens Bank. And at the end, I'm sure everybody already knows, needs no introduction, but it's Robert Bugbee, who's the President of Scorpio Tankers.
Thanks.
Well, thank you all for joining us. And just to kick this off, I thought we'd start with a relatively broad question. The shipping sector seems to thrive in times of international crisis and turmoil. And over the past few years, several years rather, we've had significant international events such as COVID, wars in Ukraine and the Middle East, attacks on ships going through the Red Sea. So shipping companies, for the most part, have been doing quite well. And have focused on building their balance sheets and paying down debt and paying dividends. However, there's still some significant financing transactions taking place. Royal Caribbean completed a $1.5 billion financing transaction a few weeks ago, and the Norwegian bond market seems to be in good shape. So with all these different factors affecting the ship finance market, we have both ship owners and bankers up here, so it'd be interesting to get their take on where we are and what's next for the ship finance market, given all the excitement that we have in these days. So why don't we start with Ted, and then we'll work our way down the panel.
Yeah, it's definitely a good time to be looking for ship finance if you're, a larger owner operator. I don't know that the market's quite as liquid or robust if you're a smaller owner, but. Like Tony said, we've all got our balance sheets, I'd say at this point, in really good shape. A number of us are paying dividends, and even we're selectively looking at growth. So nice time to have so many options available to us. It is kind of funny to hear bankers complain about too many prepayments and now anxious to put money out the door. The trick for all of us as owners is to be disciplined and smart about taking advantage of that debt capital. And the one thing I would point out, and I've had this discussion with many bankers, is they're all telling me how cheap it is right now and how they love us so much, which they tell all their clients, of course. But margins at 150, 200, well, that's really attractive. But when SOFR's it's at 470 now, down from 530, we're still financing at rates that are significantly wide of where we were all financing just a few years ago. So, the interest chunk that your total cash cost per day that was constituted by interest is probably increased, net, and so it does, have an impact on everyone's overall financing decisions and capitalization decisions.
We can swap that for you and get that down below 4.7. But I think, and thanks, Tony. I think, unfortunately, I don't really have anything earth-shattering to sort of say up here. I think you kind of hit it right on the head, Tony. The markets have obviously been strong the past few years. What that has resulted in, as we all know, is that there's been a lot of prepayment of debt. I think especially where, in the instance of traditional kind of bank financing, which can be prepaid, flexibly, we're starting to see a lot, or we have seen a lot of deleveraging. I think, we think as D&B a little bit more broadly than just providing a loan. I think we think with some of my partners on the capital markets side, you talked about the Norwegian bond market. I think that's something that has been incredibly active this year. But I think, one area where I think we will start to see, looking forward, a little bit more action is sort of as we start to see, which we've already started, particularly on the LPG side and on the gas side, a bit more ordering in some of these other markets where I think that need for kind of your traditional, although perhaps bespoke, perhaps ECA type of financing can really play a nice role.
As one of the bankers up here, I was starting to feel guilty about complaining about prepayments. But Ted solved that for me. Now I'm hearing owners complaining about SOFR being so high. So now I feel better. But SOFR a bit high, so debt break-even's a bit higher. Values are high, earnings are high. Interesting time to be lending into that. And at the same time, margins are coming down. Covenants are getting looser, so to be a bigger owner, we're between two very big owners, that's a nice position to be, to get your balance sheet in order. So interesting times, and I'll steal another line from Ted, which is the discipline. So we're going to really work hard to be disciplined. As soon as someone says the word paradigm, I'm leaving the room.
I think we've, in the tanker side, gone from famine to feast. So you mentioned world crisis, just before COVID, we were starting to be told by the main lenders that, they wouldn't be lending to tankers really much in the future because of something called the Poseidon sort of theory that they had, and that they were going to abide by this, and that we were second only to, untouchables, to the real untouchables, which was offshore. We were very close. And now things have changed. They're trying to touch and feel us up all over now. And, and for many of the banks, thank God they did lend to offshore, because that enabled them to make money, a couple of years ago. So we've now got a surplus of lending to the strong tanker companies. And I think that we're seeing some, joking aside, we're seeing some, let's say, more discipline from the top lenders in wanting to lend to the bigger balance sheets, the more longer-term positions, and wanting more than just a straightforward transactional deal of they lend, the ship owner borrows. I'm not sure what that means going forward, because you've got two different things. I think you alluded to it. In the tanker side, virtually every balance sheet's in fantastic position and is deleveraged. Yet the new building order book is increasing, which obviously by definition is a more leveraged to be financed deal. So I think it's going to be interesting for us to watch, considering that many of the owners, especially the public companies in tankers that have the deleveraged balance sheets, also don't have big order books. So it looks to me like you guys will be going to be lending to private companies a lot more in the future.
Interesting. So one other thing that we could maybe discuss a little bit is in 2020, as I think we can all remember, during the COVID era, the interest rates were very low, and so a lot of shipping companies took on a lot of debt, which will be, in many cases, I think, maturing 2025, 2026 timeframe. So this will put a lot of companies in a position where they have to make a decision. As we've discussed, everyone's paying down their debt, and interest rates have been high, so no real incentive to refinance during the last 5 or 6 years. So what do you think is going to happen with companies as these debt obligations mature? Is there going to be a real incentive to just pay them off, which a lot of companies will probably be in a position to do? Or are there other strategies that you think are important for shipping companies and investors to consider as they face this as we go into the next year and a half or two? So Andrew, you want to start, and then we'll just work our way around.
Yeah, I mean, I think you referenced a financing for Royal Caribbean a couple of months back. I think that's a good example of the cruise businesses in general. I think have demonstrated their resilience. I mean, we all know there was a period in 2020 when these businesses literally had zero revenues. So of course, having to sort of these are companies, and I think this really goes across the spectrum for shipping. I mean, the capital markets remain open. So I think companies that put themselves in position over the past few years where they had to sort of lever up, whether it was for survival needs in that particular example, or if it was to sort of refinance. I mean, my opinion is that I think both banks, the capital markets are going to be there. Another thing which I think we're obviously quite aware of is the sort of Eastern leasing market. You look at businesses that are perhaps cash flow contracted, that have a meaningful, relatively meaningful amount of leverage. You really have seen a bit of a shift, at least historically, in terms of the lender composition. So, what once upon a time was predominantly European banks that are providing that debt capital, today that's maybe sort of 75, 80% leasing, and the remaining 20% is on the bank side. So you really have seen a shift there. But I do feel that banks and capital markets will remain open.
And,
Yeah. No, it's interesting. So ship owners and old bankers realize things change. So, and we'd like to keep the business. So with those two things in mind, you don't throw away a relationship. So you know the client, or your banker. How do you keep it going, even though you have a lot of extra cash at this time? So we're working with, and it's no secret, the revolving facilities. So you have extra cash, pay down the facility, you can draw it down again. So we find a way to keep the client relationship. The client finds a way to keep the banking relationship, and it's a bit of a treasury management tool. So yes, there's some extra cash which will get soaked up by new buildings coming in, S&P opportunities that always come up. Maybe the rates don't stay this high forever. So
We undergone a massive change. So at the end of 2021, we got through COVID by selling vessels into leasing companies and leasing them back. We did everything we could just to keep the liquidity to stay afloat. By Christmas of 2021, we were more or less effectively 90% loan to market value on the vessels. We were very, very close to, it was literally every week you do a count of the cash to make sure you had the required cash covenant to cover your obligations relative to the small amount of money that you had to the commercial lenders. By the end of this year, from the 90 vessels that we had in lease finance, the end of December 21, we'll be down to just 2. And the actual net debt or loan to value will be, somewhere between 10 and 15%. And most of the lending will be, and lending facilities, and will be with commercial banks. And what's more, we will have we'll have almost double the amount of debt that we will have drawn in undrawn revolving facilities. So this is the change that has happened. So my expectation going forward is, how do you improve that? I'm less concerned with the, I think one thing to remember, I'm less concerned with the actual margins and the SOFR rates, because it's not really that is so important in the long term for shipping, because our rates will change so much anyway that it overwhelms whatever you're saving on a SOFR on interest. What's really strategically important is the structure of your borrowing. And I think that we would look to, as we've done now, to first of all put in revolvers. I think we would look to, as our earnings mature and we start putting trailing 2 years of great earnings, I think the company would look to diversify again its borrowing and look to add some form of public bonds to the actual debt structure that we have.
Interesting. Yeah, Ted?
Not much left over. Yeah, I mean, I think as I think about our own refinancing needs, we have a small refinancing coming due in 26, at the end of 26. On one level, that's a long time away, so I think markets will move. They obviously will. And I think the one thing that I think we hear a lot from the banks is what are you guys up to? Basel III now?
Soon to be four.
Soon to be four. And so, by the end of 26, who knows what that actually will mean in terms of borrowing costs. And, I hear what Robert's saying, and he's not wrong, but when we do our own capital budgeting, we kind of look at long-term rates. And we know that there's going to be ups and there's going to be downs, but we kind of know that our interest is going to be within whatever band. And it's got to make sense, looking at long-term historical averages at least one way. So, I think, and again, our fleet size is substantially smaller than Scorpio's, so maybe we have to look at it a little more minutely, granularly. But I think as we look ahead, structures that we've preferred and found, are I would say very covenant light, or in some cases covenant free structures that we have. Longer dated loans, we managed to, and when everybody was asking to, what could we do during COVID, and I said, well, we might refinance, but can we do? I don't want to do a 5-year deal. How about a 7-year deal? And surprisingly, people were amenable to doing a 7-year deal. So, I'm hoping that we're going to see longer tenors so we won't get in the usual treadmill of refinancing every 4.5 years. But, we'll see how the market evolves over time. Everybody's pointed out, the bond market's there. It opens and shuts. And I'm sure I suspect it will be there because the interest rates are attractive and just the way things work. Convertible bonds could be something, again, which is, obviously more of an equity-linked instrument. But again, that there, for those of us in the capital markets, there's a number of different opportunities. And, as Robert's alluded to, they've done a fantastic job of, I think, fairly strategically tapping a lot of different sectors. And, I think that's a good playbook for a lot of us to look forward to as this refinancing wall, I dare say, comes up in 25, 26, Tony.
Got it. Thanks. So let's talk about one other issue that, looms large over shipping industry and ship finance in general, and that's the decarbonization energy transition. I think that, we all know that it's an important element of the market right now. It's you can say it's different in Europe versus the United States. It's different for traditional lenders versus alternative financial sources. How important it is or how much they focus on it, but everyone is focused on it. It's Robert alluded to it earlier today. For European banks, it's a very important element of what they're willing and not willing to do. And so I guess what would be interesting is if we could get your perspectives on, how this is affecting the market today and how you see this going forward over the next 4 or 5 years. What do we expect to see in terms of the government regulation, industry players, banks, alternative financing sources, as you're a ship owner or an investment bank or a banker trying to help their clients do their financing in the shipping industry. So, Evan, if you want to start with this one, and then we'll work our way around.
Oh, sure. I get the green question first. Let's see. Big prediction. There's going to be more regulation.
Oh, going out on a limb.
Yeah, going way out on a limb there. No, more regulation. So what do we see? How is it impacting the ship owners? Okay. Maybe a little less competitive to finance the fleet on the water for a banker. We call that the transition fleet, so we're financing the transition fleet. I was looking at Robert as if he was Michael Parker.
I think we're quite different.
Yeah. But the other big one we see is owners looking for their new builds and keeping the optionality in the fuel type or the engine type. So I'm guessing, going out on a limb here again, that ships become slightly more expensive. So now we have higher asset values, and how are we going to support those higher asset values? How are we going to support our clients investing in those higher asset values? And that, for us, at least as an American bank, is going to be cash flow visibility. So as long as we see that contract cover and gets us to a normal in quotes, level, we can get comfortable with financing the more expensive, greener ships, if you will. So that's how we're starting to think about it.
Okay. Robert?
Oh, it's a joke, really. I mean, I'm so lucky to have the fluke opportunity to be on this panel today, because that really, the banks are talking a great game. They need to talk a great game on environment, but it's the dollars that matter, and the credit that they give the owners who have the good ships and have the good ship fleets and have the good vettings on their fleets and relationships and, you know, proper environmental reporting and third-party, you know, responsibility, etc., is like nothing. I mean, there's nothing. It's just yes, we really like to do this, and Poseidon's fantastic, and, you know, it's brilliant, you know, but it's nothing. We need to have, and we need to accept that. And I'm not blaming the banks. That's sort of what they should do. If they can get away with the talk without paying much for it, that's okay for a business to do. But the only thing that's going to happen is the regulation. The regulation excludes those ships and bad operators. That's the only way that's going to happen, because the banks will lend to those people where they can make money as a group, because they're a business. And that group will exist to the extent that they're able to exist. So the only way that you're going to actually deal with the environmental green thing is through stricter regulation and stricter enforcement.
Yeah. You have to up with sort of the traditional banks versus alternative financing sources also, right? 'Cause to the extent the banks are regulated and forced to do what you just said, it's more difficult to regulate sort of credit equity funds and other people who aren't regulated like banks are.
Yeah, but it's the actual vessels themselves and the operators that need to have the regulation.
Exactly.
So the temptation for the lending side isn't ever there.
Yeah.
Because if you didn't have those substandard positions or those environmentally weak positions, you wouldn't have the issue.
Right. Ted?
Yeah, I mean, I think, as usual, Robert summed it up pretty well. I mean, you know, we're given a very generous 5 basis point reduction in our margin for significant investments in reducing our average emissions ratio. I mean, it's really not much. Sorry, guys, but you know, you could be a bit more generous when you preach the green stuff. You know, and I think, you know, Tony, to your point, look, we've already seen a bifurcated, trifurcated lending market. And look, you know, today, most of the owners, probably all the owners in this room, are compliant with, you know, every kind of MO regulation there is. We don't turn off our transponders. You know, we pay our crews. They're not the guys that these guys worry about and the regulators worry about, and certainly not the guys these guys are going to lend to. So, you know, as long as there's, you know, forget about the dark fleet, as long as there's a gray fleet that, you know, is operating sort of on the edge of regulation, you know, that's going to ultimately have some impact on all the rest of us who are playing by the rules. But, you know, one would expect perhaps over time, you know, we'll see the noose tightening and, you know, sort of level the playing field for all involved, but TBD.
You know, I'll say that I think first and foremost, I'm thankful I got a bite at this question after Robert and Ted. But I think, you know, as a bank, as a Norwegian bank, you know, something that I think we take quite seriously. You know, we of course have our own net zero ambitions that we're striving towards. But I think when it comes to our customers, when it comes to sort of the existing fleet, I think, you know, we're very pro modernization of the existing fleet. I think that that's something that ought to be the priority. We want to see our customers taking a proactive approach towards that. I think we sort of pride ourselves on being pragmatic in this situation. I think there are extremes. If someone were to say, I'm going to sell my fleet of conventional ships and order a whole bunch of unproven technology, I think that might not be the perfect fit for us. But, you know, ultimately, I think we partner with our clients and look to kind of work together. And I think it needs to be a risk-based approach. I think there has to be lender, charterer, owner. There really needs to be everybody sort of giving a little bit there. But Ted talked a bit around the sort of plus and minus 5 basis points on the sustainability loan side. I think that's actually something that I think we're seeing people shy away from that a little bit now. A lot of that, as you pointed out, is kind of AER based, some of these KPIs. And ultimately, I think as an owner, you may not necessarily have the ability to control where your ship is going and some of the sort of factors that show up within AER. So it's ultimately out of your control, and perhaps you miss. But I agree, 5 basis points isn't exactly moving the needle. We recently put out a transition loan framework. I think that's something that we're really standing behind and sort of working with our customers in sort of emissions intensive industries to sort of provide capital to sort of improve that. And ultimately, I agree with what Robert said. I mean, we like to make money. So the thought around not lending to tankers or hydrocarbon-based, we like offshore, we like tankers. So, all of that comes together. I think we're just trying to be pragmatic about it.
Okay, thank you. Well, look, it's election season here in the United States, and I thought it might be interesting to get views from the panel on, if you look at the difference in the presidential candidates in the U.S., you've got President Trump, who I think would be, at least what he says, is more focused on U.S. manufacturing, increasing and providing incentives to increase oil and gas production in the United States, increasing dramatically tariffs on imported goods. And then you have the Harris administration, which I think would be, at least if you based on what you hear, status quo, kind of what we have now. Not a lot of big increases in U.S. Production of oil and gas or increases in tariffs. And I'm just wondering how you all think that a change of administration or continuing with what we have now, in addition to the sort of overall regulatory view of the Donald Trump versus President Harris, how that would impact the shipping industry and sort of ship finance in particular. Robert?
I don't get a vote. I mean...
It's not a matter of who you think should win, it's just what do you think would...
I mean, I've been here 30 years, paid taxes for 30 years, right? You had a revolution over this against some country years ago, right? It's very difficult because, to be honest, is that there's the Trump show, and then there's the Trump what he's actually going to do, right? So I don't think you're going to get all the things that Trump is saying he's going to do with regard to banning trade, et cetera, et cetera, et cetera. And, the population is, a lot of his voting blocks are going to be dependent upon, cheap imports from certain countries, et cetera, et cetera. So I think there's a big difference between the two. I think that the American system is set up that you don't necessarily get all of what the politicians are going to say they're going to get and implement it straight away anyway, because of the way that laws are created and then enforced. I think that superficially, crude oil market would probably benefit, obviously, if you had more drilling and more production over in the West, because you get longer routes east towards China. But there again, you've got this really weird thing that if you're then going to do that on one side and then persecute the biggest customer out there in China that you're going to have for the U.S. oil industry on the other, that's difficult to handicap.
Yeah.
So, shipping seems to find a way to deal with all the different types of governments that the U.S. and the bigger countries have. And as you said, we react far more to general world economy and general crisis than individual government things. And we don't pay taxes anyway, right? So it's a big plus in the election.
It's a nice position to be in, yeah.
So,
Well, I think that's one thing we hopefully will preserve in either administration is our well, I won't say tax-free, but our offshore status in terms of the source of our revenue and income. But yeah, I tend to agree with Robert. I mean, we are in our sector, during the last Trump administration, China slapped retaliatory tariffs on U.S. LPG imports, and it really it didn't change anything. We were in a bad point in the cycle, but global exports and global seaborne trade continue to grow. All it meant was, U.S. cargoes didn't go to China. They went to Japan, Korea, India, the other big importers, and China sourced most of its LPG from the Middle East. Probably less possible now because LPG production in the Middle East is, down a bit, and U.S. has taken, more of the share, and China's more dependent on us. But regardless, we are in the most global markets in the world, and like Robert said, I think shipping tends to figure out a way, and the commodity traders and big oil who are behind it all are pretty clever about rebalancing needs as things go, regardless what the political environment may be. So I don't expect massive changes by any stretch.
Fully agree. I mean, I think, ultimately, I don't think there's a efficient way to replace shipping, right? So we've had in the past, obviously, different parties in office, and I don't think that there's necessarily one thing we could point to that says someone is going to do this, and that can have a really awful or positive impact on shipping. But I think, one of the things that I'm always thinking about, and we talk about this a lot, particularly in the context of, what happens to the Inflation Reduction Act. But ultimately, things have to get through Congress, right? So it's not like one person has the ability to switch something on or off. It needs sort of vast support, and that's something that I think no crystal ball here, of course. But my opinion is sort of shared with the guys before me. I don't think there's really going to be too big of an impact depending on who's in office.
Oh, I answered the green question. I'm not answering the Trump question. It doesn't come into our...
I mean, there's one big concern, though, for the general shipping industry in the U.S. if Trump came in. Seriously big concern, and that's the reimposition of the wine tariff.
The wine tariff would be devastating, yeah.
That might impact some of us.
Yeah.
That could impact a lot of expense accounts, particularly from the chartering side of the business.
That's important. That's important to keep in mind. I'm sure everybody's
yeah.
written that down. Look, we have a few minutes left, and one last thing I guess we could touch on quickly is sort of traditional banking versus alternate financing sources. We've touched on a little bit as we've gone through here. But what sort of specific things are you all looking at when you're making a decision whether to go through traditional banking relationships or alternative financing sources? Are there specific things specific to companies, or are they macro factors, or what are the typical things you're looking at?
I mean, I think obviously we're sensitive to cost and structure, but I think the big thing for us is with the perspective of time is reliability. Look, I forget, the shipping banker told me, but some insane percentage of shipping loans get amended at least once during their life, which keeps a lot of you guys employed too. And so the question is, who's going to be sitting across the table? And for us, we've dabbled in alternative finance, it's certainly got its attractions. There's no question about it. The one thing that's tricky is when times are tough, I know that if I've got a loan with, either Evan or Andrew, if I pick up the phone, they're going to answer. It may not be the world's greatest conversation, but I know it's going to be constructive, and I know they're going to understand our perspective, and they're going to expect me to understand their perspective. I think the knock on some of the alternative lending sources is, they'll be happy to either not respond, jack up rates, charge you big fees, and look, that's their business model. So we're all big boys and girls here, so we go in with eyes wide open. But from Dorian's perspective, every time we've kind of gotten closer to an alternative finance solution, we've seen the goalposts move. We've seen certain fundamental things change, and that doesn't happen with our traditional lenders. And that's worth a lot. Yes, you may pay for that a little bit in flexibility or even rate or fees or whatever it is, but it's probably a pretty good long-term investment, at least from our perspective.
I think during times where we talked earlier about sort of the interest rate environment, I think relative to kind of your traditional, and I think the word alternative is interesting because some of these lenders have been around for decades. But I think in a rising or higher for longer interest rate environment, I think that capital relative to kind of your traditional bank capital probably is a little bit more similar from a cost perspective. But I think where we differ is a couple of things. Mainly, I think flexibility of structure, especially in a time where markets from a freight perspective have been strong and you're seeing a lot of deleveraging. I think your bank, traditional kind of bank financing, most of the time does not have prepayment penalties. So that's something that I think is, of course, flexible. I think we differ in size. I think we're capable of committing a lot more capital. And then I think it's also really where we're competing, and I don't think we compete too often, but I think where we are competing, at least speaking for D&B, I think we've run into alternative lenders in competition with sort of the Nordic bond product or the U.S. high yield product, where I think alternative lender who can bring size. I mentioned the sort of prepayment penalties, but I think they oftentimes want to see amortization, and I think that's often where we've seen kind of swimming in the same pool, so to speak.
Yeah, and there is a great alternative, no pun intended. I mean, before my banking gig, I was working as a consultant advisor to ship owners, and it really was bespoke. It was dependent on what the owner needed, higher leverage, shorter term. They needed the money at any cost, or they could take lower leverage and less flexible terms from the commercial bank, and it really fit them. Some cases, it was good to have the optionality. It was nice you had a leasing option. In terms of competition, not really, much more cooperation. We have a relatively inexpensive source of capital, so we'll partner with the alternative lenders. That's a fairly big part of our business, so we'll partner with the Entrusts and the Australises and the Mirbaums or Oak Tree companies and give them back leverage. So we get what we want, which is the senior secured, and they get to get some deals done. Everyone, huh?
Well, I think I have the happy memories as well as worrying the scars of financing in tough markets. And so just out of experience, if you've already got the traditional bank finance, it is without doubt the best in terms of its flexibility, its economics, its ability to sit down and talk with another party who is a partner. But if the market is bad, if it's turned into a crisis, then, next to, they're even worse than equity. At least you can get equity at a price in a bad market. You can't get bank finance in a bad market because, firstly, it takes too long. The market is driving down and your fundamentals are getting worse and worse, quicker than the banks can actually get stuff through credit committees. And you're normally only one of a group of people who are in trouble too. Whereas alternative finance, like we use the lease financing, was incredibly efficient and effective. Yes, it was expensive, but they gave you what you want, and sometimes they gave it to you literally within 14 days. And, so it's horses for courses and markets.
Okay.
So.
All right, thank you. So I think we managed to get that almost exactly on the nose. We've got about 30 seconds left. So I appreciate everybody's time, though. Thank you all very much. I appreciate it.
Good job,
it was
Tony.
very nice.